There's a folder in a young woman's email account with over 60 unread messages in it, all from the same sender, all with the same slightly awkward subject line her father always used, something like a thought for you, or worth reading when you have a minute. She never opened them, not because she didn't love her father, because every single time one arrived, she assumed, correctly, that it was going to be about money, investing, retirement accounts, some topic that felt, at the time, about as urgent to her as reading the instruction manual for a dishwasher she already knew how to use just fine. She was in her 20s. She had a job, rent to pay, friends to see, an entire life that felt far too immediate and far too interesting to spend any part of it thinking about index funds or something called an expense ratio. So the folder simply grew quietly for years. 60-something letters sitting completely unread, a small monument to every well-meaning piece of advice she'd decided, without ever really deciding, wasn't worth her time yet. Then one Tuesday afternoon, in her early 30s, she sat in her car in a parking lot, having just left a meeting with a financial advisor who'd spent 45 minutes talking in a language she barely understood. Words like load fees, and actively managed, and risk tolerant, using a tone that made her feel simultaneously anxious and somehow stupid for not already knowing what any of it meant. She'd walked in hoping for clarity. She walked out feeling worse than before, more confused, more convinced that money was simply a subject reserved for people smarter, or luckier, or more naturally gifted than she was. Sitting there in her car, for reasons she couldn't fully explain even to herself, she opened her phone, scrolled back through years of emails, and found that folder, the one with her father's name on it, 60-something letters deep, and she started reading. From the very beginning, here's what she found, and it's going to reframe almost everything the financial industry has ever told you about how complicated this subject is actually supposed to be. Her father had never worked in finance professionally. He wasn't a fund manager, or an economist, or someone with a wall full of framed credentials. He was simply a man who, decades earlier, had made a series of mistakes with his own money, learned from every single one of them, and eventually arrived at a way of thinking about wealth so simple, so almost embarrassingly straightforward, that it directly contradicted nearly everything the 45-minute meeting she'd just left had tried to convince her was necessary. His name, in the story we're following today, is J.L. Collins, and by the end of this video, you're going to understand exactly why he believes the entire financial advice industry has a powerful incentive to make investing sound far more complicated than it actually needs to be, why a single, remarkably boring investment choice can outperform most professionally managed portfolios over the long run, and why the real goal of building wealth was never really about the money itself, but about something he calls a very specific kind of freedom, one that lets you walk away from any situation in your life, a job, a relationship, an obligation, the moment it stops serving you. Stick with me, because that freedom has a blunt, slightly irreverent name in Collins' own writing, one that might make you laugh the first time you hear it, right before you realize how seriously he actually means it. Let's go back to where Collins' own financial education actually started, because, like most people, he didn't begin with any special knowledge at all. He began, in fact, making mistakes. Early in his adult life, Collins found himself carrying meaningful debt, and he describes, honestly and without much self-flattery, exactly how uncomfortable that period genuinely was. The constant low-grade anxiety of owing money he didn't have readily available, the sense that his own financial life was somehow controlling him, rather than the other way around. It was around this time that a close friend, a man Collins refers to simply as Jack in his own retelling, Someone considerably further along in his own investing journey sat him down and offered a piece of advice that Collins initially found almost too simple to take seriously. Jack told him essentially that debt itself was the enemy, not any particular type of debt, not just the obviously bad kind, but debt in general, arguing that as long as Collins owed money to someone else, his own financial decisions would always be constrained, always be shaped around servicing that debt first, before he ever had genuine freedom to build anything of his own. Collins took the advice seriously, worked deliberately to eliminate his debt entirely, and once that pressure was finally lifted, he turned his attention toward actually building wealth, rather than simply managing obligations. And this is where his story takes an interesting turn, because his early attempts at investing looked almost nothing like the simple approach he'd eventually become known for. He tried picking individual stocks, researching companies, trying to identify which ones might outperform the broader market, exactly the way most people assume successful investing is supposed to work. Sometimes these picks did reasonably well, sometimes they didn't, and Collins describes watching money he'd carefully saved shrink because of decisions based on research that, in hindsight, wasn't nearly as reliable as it had felt at the time. Here's the twist that eventually reshaped his entire approach, and it's worth sitting with directly, because it goes against almost everything the financial industry generally wants you to believe. The more Collins studied the actual long-term data on individual stock picking, and on professionally managed investment funds more broadly, the more he discovered something genuinely uncomfortable for an entire industry built around the opposite idea. The vast majority of professionally managed funds, run by people with genuine expertise, genuine credentials, genuine access to research most individual investors could never hope to match, still failed, over long periods of time, to outperform something remarkably unglamorous, a fund that simply owns a small piece of the entire stock market, every single company in it, without any attempt to pick winners or avoid losers at all. This particular kind of fund is called an index fund, and Collins eventually became one of its most passionate, plain-spoken advocates, precisely because the data kept telling him the same story, over and over, decade after decade, trying to beat the market through clever stock picking, through professional fund management, through complicated strategies designed to outsmart everyone else, overwhelmingly fails to actually beat the market itself, once you account for the fees charged along the way. Here's why this matters so enormously, and it's a detail that tends to genuinely stun people the first time they see the actual math laid out clearly. A seemingly small difference in fees, something that sounds almost trivial when quoted as a single percentage point, compounds over decades into a genuinely staggering amount of lost wealth. Imagine two people investing the exact same amount of money over the exact same number of years, earning the exact same underlying market returns. One of them pays a modest annual fee to a professionally managed fund, something that sounds small enough to barely notice, maybe 1% a year. The other invests in a low-cost index fund, charging a small fraction of that amount. Over a working lifetime, that seemingly tiny difference in fees, compounding year after year, can end up costing the first investor hundreds of thousands of dollars in lost growth, money that never had the chance to compound on their own behalf, because it was quietly siphoned off, one modest percentage point at a time, into someone else's pocket instead. This is the exact mechanism that made Collins so deeply skeptical of the broader financial advice industry, and it's worth understanding clearly because it directly explains why that 45-minute meeting his daughter sat through felt so unnecessarily complicated in the first place. An entire industry, built around actively managed funds, financial advisors charging ongoing fees, complicated products layered with jargon most people never fully understand, as a powerful financial incentive to make investing sound difficult, sound like something requiring their specific, paid expertise. Because simplicity. Here's a pause worth taking right now, honestly, with nobody else watching. If someone in your life is currently paying meaningful ongoing fees to a financial advisor or an actively managed fund, do you actually know, specifically, what those fees are costing over the full span of a working lifetime, not just this year, but compounded across 30 or 40 years of investing? Because, according to decades of actual data, the specific number is very often shocking, and it's a number the industry itself rarely goes out of its way to show you clearly. Now, let's talk about the specific approach Collins eventually settled on, the one he later wrote about extensively in those letters to his daughter, because its simplicity is genuinely the entire point. His core recommendation, distilled down as plainly as possible, is this: invest consistently in a broad, low-cost index fund that owns a small piece of the entire stock market, every major company within it, rather than trying to pick individual winners or time when to buy and sell based on short-term market movement. That's essentially the entire strategy. No complicated formulas, no proprietary trading systems, no need to constantly monitor financial news trying to predict the market's next move. Simply invest consistently over a long period of time in a fund that captures the market's overall growth, and then, critically, leave it alone, resisting the very human temptation to tinker, to panic, to chase whatever seems exciting in the moment. This last piece, leaving it alone, turns out to be far harder in practice than it sounds, and Collins illustrates exactly why through one of the most important stories in his entire body of writing, a story centered on a financial crisis that devastated countless portfolios and countless nerves. In the late 2000s, during that crisis, the broader stock market fell dramatically, losing a substantial portion of its total value over a relatively short period of time. And Collins describes watching friends, colleagues, and countless strangers panic, selling their investments at exactly the worst possible moment, locking in enormous losses out of pure fear, convinced the market might never recover at all. Some of these people never reinvested afterward, having been so thoroughly frightened by the experience that they simply stayed out of the market entirely, missing the substantial recovery and subsequent growth that eventually followed over the following years. Collins made a different choice, one that felt at the time genuinely uncomfortable, watching his own portfolio's value shrink significantly on paper, while resisting every instinct telling him to sell and simply make the losses stop. He held on, continued his regular investing exactly as planned, and over the following years, watched the market not only recover its losses entirely, but grow substantially beyond where it had originally been before the crisis ever began. Here's the specific lesson Collins draws from this experience, one worth stating clearly, because it directly connects to something we touched on earlier regarding fees and complexity. The stock market, viewed over any sufficiently long period of time, has always eventually recovered from every single crash in its entire history, and has always eventually gone on to reach new highs beyond wherever it had previously fallen. This doesn't mean every individual crash is comfortable to live through, and it certainly doesn't mean there's no genuine risk involved in investing at all. But it does mean that the investors who tend to suffer permanent, irreversible losses are very often not the ones who simply held on through a difficult period, but the ones who panicked, sold at the bottom, and then either never reinvested at all or waited too long to get back in, missing much of the recovery that eventually followed. There's a specific phrase Collins uses to describe the emotional discipline this requires, something worth sitting with directly, because it explains why so many people, despite genuinely understanding the math, still struggle enormously to actually follow through on it in practice. He argues that surviving a market crash without panicking isn't primarily an intellectual challenge. It's an emotional one, requiring a person to sit calmly, watching their own hard-earned savings shrink on paper, trusting a long-term historical pattern, even while every instinct in their body is screaming at them to do something, anything, to make the immediate pain stop. This is precisely why Collins spends so much time in his own writing discussing not just the specific investment strategy itself, but the psychological preparation required to actually stick with it. Because a strategy this simple only works if a person genuinely has the discipline to leave it alone during the exact moments it feels hardest to do so. Now let's talk about something Collins discusses with real personal weight, an experience from his own life that reshaped how he thought about a completely different kind of investment altogether. Real estate. Collins had, at one point, owned rental property, believing, like many people do, that real estate represented a solid, tangible way to build additional wealth alongside his stock market investments. Then, one day, a fire destroyed that property entirely. He describes the experience honestly. The shock of losing a physical asset he'd invested significant money and effort into, followed by the frustrating, drawn-out process of dealing with insurance claims, property management complications, and the sheer amount of ongoing attention that particular investment had required of him, attention that, in hindsight, felt disproportionate to the actual returns it had generated compared to his much simpler stock market investment. This experience became a turning point in Collins' broader philosophy, reinforcing something he'd already begun to suspect from his earlier mistakes with individual stock picking. Complexity itself, whether in the form of actively managed funds, individual stock research, or hands-on real estate management, tends to demand a disproportionate amount of time, attention, and emotional energy, often without producing meaningfully better returns than a much simpler, much more boring approach would have delivered anyway. He began to see genuine value in simplicity itself, not just as a convenient shortcut for people who didn't want to put in the effort, but as a genuinely superior strategy in its own right, one that freed up time, attention, and emotional bandwidth for the rest of life, while still reliably building substantial wealth over the long run. Here's where Collins introduces the idea that gives his entire philosophy its most memorable, most quietly radical name. He calls it F.U. money, and the bluntness of the phrase is entirely intentional. The idea is this: once a person has accumulated enough invested wealth that the income it could reliably generate would cover their actual living expenses indefinitely, they gain the ability to walk away from any situation that no longer serves them. A job with a difficult boss, a company whose values no longer align with their own, any obligation that's become genuinely unbearable, without the paralyzing fear of financial catastrophe that keeps most people trapped in situations they'd otherwise leave immediately. Collins describes this not as an invitation to actually quit every difficult job or relationship the moment things get uncomfortable, but as a fundamental shift in the balance of power within your own life. The difference between staying somewhere because you genuinely choose to versus staying somewhere because you feel you have no other financial option available to you at all. There's a story he tells of someone who reached this exact point. Having built substantial invested wealth over roughly 15 years of consistent, boring, unglamorous index fund investing, who found themselves in a work situation that had become genuinely toxic, a manager whose behavior crossed lines that would have felt impossible to walk away from just a few years earlier. Because this person had quietly built enough FOBU money to cover their living expenses for a significant stretch of time without any income at all, they were able to have an honest, direct conversation with leadership about the situation, without the usual fear that speaking up honestly might cost them everything. The situation improved shortly afterward, not because of any dramatic confrontation, but because they were finally able to advocate for themselves from a position of genuine strength rather than desperate compliance, precisely because the money sitting quietly in their investment account gave them real, tangible leverage they'd never had access to before. This is the actual heartbeat of everything Collins writes about, and it's worth pausing on directly, because it reframes the entire purpose of building wealth in the first place. The goal was never really about accumulating an impressively large number for its own sake. It was about buying yourself genuine options, genuine freedom, the ability to make decisions about your own life based on what you actually want, rather than what financial desperation forces you into. Now, let's talk about a specific number Collins discusses in detail, one that tends to genuinely surprise people the first time they encounter it clearly explained, because it directly answers a question almost everyone eventually asks themselves at some point. How much money do you actually need to retire or to reach that FU money threshold in the first place? Collins references research suggesting that if you withdraw approximately 4% of your total invested savings each year during retirement, adjusting slightly for inflation along the way, your money has historically had an extremely high likelihood of lasting for several decades, even accounting for the market's inevitable ups and downs along the way. This means, working the math backward, that if your annual living expenses total a certain amount, you would generally need approximately 25 times that amount saved and invested in order to reasonably expect your money to support you indefinitely without ever needing to return to traditional employment at all. There's a couple in Collins' broader circle of readers, people who took this specific calculation seriously in their 30s, tracking their own annual expenses carefully, and working backward to determine exactly how much they'd need invested to reach that 25 times threshold. Rather than assuming retirement was something reserved for their 60s, decades away, they realized, once they actually ran their own specific numbers, than either of them had ever previously imagined. They didn't achieve this through any risky, complicated financial strategy. They achieved it through exactly the approach Collins spent his entire body of writing advocating for: consistent saving, low-cost index fund investing, avoiding unnecessary debt, and resisting the temptation to constantly upgrade their lifestyle every time their income happened to increase. Here's a question worth sitting with right now, honestly, with nobody else watching. If you calculated your own current annual living expenses and multiplied that number by 25, would the resulting figure feel impossibly distant, or would it feel like something you could genuinely work toward, one consistent year of saving and investing at a time? Now let's bring this into the world you're actually living in right now, because the specific forces working against Collins' simple approach have, if anything, multiplied since he first began sharing these ideas with his daughter. Today's financial landscape offers an even wider array of complicated products, sophisticated-sounding investment apps, cryptocurrency schemes, individual meme stocks, promising rapid, exciting gains, each one competing loudly for attention against the comparatively boring, unglamorous strategy of simply investing consistently in a broad index fund and leaving it alone for decades. Social media has made this temptation even stronger, constantly surfacing stories of people who supposedly made enormous, rapid gains through some clever, complicated strategy, while the much larger number of people who quietly lost money attempting those same complicated strategies rarely gets the same visibility or attention. Meanwhile, the underlying math Collins spent his entire career emphasizing hasn't changed at all. Broad, low-cost index funds still, over long periods of time, continue to outperform the majority of actively managed alternatives once fees are properly accounted for, and the psychological discipline required to simply hold on through market downturns remains exactly as difficult and exactly as valuable as it's always been. Here's the modern application worth genuinely acting on this week, something concrete, something you can actually start researching in the next few days. Look honestly at wherever your own money is currently invested, whether that's a retirement account, a brokerage account, or savings sitting somewhere earning very little at all, and identify exactly what fees you're currently paying, whether to a financial advisor, an actively managed fund, or any other ongoing cost layered quietly into your investment. Then compare those fees directly against the cost of a broad, low-cost index fund and calculate honestly what that fee difference might cost you specifically, compounded over the remaining decades of your own investing timeline. That single comparison, more than almost any other action available to you, is precisely the calculation that reshaped Collins' entire approach to money. And it's the exact calculation his daughter finally sat with, alone in her car, reading through years of unopened letters for the very first time. Let's return, one final time, to that young woman in the parking lot, scrolling through 60-something unread messages from her father, finally reading, from the very beginning, everything he'd quietly tried to tell her for years. She didn't become a financial expert overnight. She didn't need to. She simply opened a single low-cost index fund account that same week, set up automatic contributions from every paycheck, and did something that felt almost anticlimactic given how much anxiety the entire subject had caused her for years beforehand. She left it alone. She stopped attending meetings with advisors trying to sell her complicated products she didn't fully understand. She stopped feeling like money was some mysterious subject reserved for people naturally smarter or luckier than she was. And slowly, quietly, over the following years, exactly the way her father had described in letter after letter she'd once ignored, her own modest, consistent contributions began to grow. Not explosively, not overnight, but steadily, in exactly the unglamorous, boring way real wealth actually tends to build, given enough patient time. That is the entire heartbeat of everything we've walked through together today. The path to genuine financial freedom was never actually complicated. It simply looked complicated because an entire industry has a powerful financial incentive to keep it looking that way. If this reframing, simplicity over complexity, patience over panic, freedom over accumulation for its own sake, resonated with you at all, because somewhere out there right now, there's another folder of unread advice sitting quietly in someone's inbox. Another person one honest conversation away from finally understanding that the simplest path was, the entire time, sitting right there in front of them, waiting patiently to finally be. Read.